Here's what banks don't want you to know. Every time you finance a car, take out a mortgage, use a credit card, whatever, you're building their wealth, not yours. But what if you could flip that equation and become your own banker? In the next few minutes, I'm going to show you exactly how the infinite banking loan process works and why wealthy families have been doing this for many, many years while the rest of us keep enriching Chase and Wells Fargo. I'm Brian Moody with Remnant Finance, and I'm going to walk you through high level mechanics of how the infinite banking process actually works, step by step. No jargon, no BS, just the basic process. By the end of this video, you'll understand how the policy loan process works on a very high level. Now, I was skeptical too when I first heard about infinite banking. I thought, this sounds too good to be true. But when I saw how it actually works, everything clicked. So let me show you what I discovered. In Nelson Nash's book, Becoming Your Own Banker, which you should read if you're interested in this concept, he makes a very important point. We finance everything we buy. You either pay interest to somebody else or you give up the interest that your money could have earned when you pay cash. And many people refer to that as the opportunity cost. And there are no exceptions to this rule. So what he means by that is most people do one of two things when they purchase anything. The common example that everybody uses is cars, and it's a good one because just about everybody has to buy a vehicle. Now, you got two options whenever you purchase that car. You can save some money and you have a certain amount of cash. Now it's time to buy the car. So you spend and deplete all that money purchasing the car. And what happens next? You have to start saving again because at some point you're going to need another car. Maybe you save a little bit more. I don't know. But you're going to spend it down again when you buy another car. And this process is just going to keep repeating and repeating. And the unfortunate thing is, after a lifetime, you still end up back at the $0 line because everything you've saved, you spent. And all of this money here that you've saved and spent, none of it had the opportunity to grow. Now, the other option, and what probably most Americans do, is we borrow money. So we go to the bank and you take a loan. So you go in debt, and over time, you pay that loan off. Well, most people, as soon as they get that, they pay that loan off and money starts burning a hole in their pocket. What do? They take another loan for the next car. They buy it, they pay it off. They do this over and over and over again. And where do they end up? Right here back at the zero line. So with infinite banking, things work a little bit different. We're going to choose an insurance company. This company needs to be a mutual insurance company. Being a mutual company simply means that all of the policy holders are owners in the company. So rather than the company taking care of shareholders with their profits, they're going to return those back to the policy owners in the form of a dividend. Now, the companies we worked with, they've all been around for well over 100 years, which is a common metric. They've all paid dividends since their inception through every economic environment that we've seen. But we're going to go to this insurance company and we're going to get ourselves a policy. So this is your policy. It's going to be specially designed, hopefully by an infinite banking concepts practitioner, in that it's going to build cash value a lot faster than your vanilla property that you can get by going down the street to your local agent. They're going to grow cash value very quickly. That cash value can work like equity. So let's say you build up a level of cash value in your policy. Let's just call this $200,000 over time. So here you are doing business with the mutual company and you need access to some of your money. Now you have $200,000 in this policy. So you're going to contact the company and you're going to say, "Hey, I need a loan. I need a loan for $100,000 or for whatever it is you want to do." The insurance company, they're simply going to look at your policy and they're going to say, does he have enough money for what he's requesting in this policy? Yes, he has total equity or total cash value of $200,000. So we can give him a loan of that $100,000. And all we're going to do is put a little lien against that first $100,000. It's not taken out of the policy. It's just simply blocked off so that you can't borrow it twice at the same time. While they're doing that, the insurance company, they're going to loan you their money from their general fund. So you're taking a loan from the insurance company out of their money, and they're going to charge you a certain interest rate. Let's call it somewhere between 5 and 8%. Now, what can you do with this money? Whatever you want. All they cared about was that you had collateral in your policy, you had capital available in your policy in the form of cash value. So if you do, they're going to loan you whatever amount you want, no questions asked, no credit checks, no major applications, just a simple request form. And they're going to deposit that into your account in usually 3 to 5 days. Now, you can take that money and do all the things you would have done. So let's say that you decide you're going to buy that car. What you used to do is you used to buy a car and you would send it out to, you'd send your payments out to the bank, making the bank lots of money. Instead of that, you have the car here. You're not going to do this anymore. You're going to send your payments from your income back to the insurance company. Now, when that happens, the insurance company, they're going to reduce this lien a little bit, which means every payment that goes back in, it works like a line of credit, and this portion would be accessible again. Now, that's awesome. You're paying them 5 to 8%. The money's going back into your policy. It's refilling that bucket. You can use it again. And you can do this over and over for anything you want. You could take over your mortgage. But where it gets really interesting and where the concept really becomes powerful is when you start doing it for investments. So let's say you have a business opportunity. Let's say you want to buy real estate. Or let's say you want to make loans, hard money loans to somebody else. You're going to do the same process. The insurance company is going to loan you the money. You have the money in your hand, and you're going to take that money and do these things. And I'm going to go straight to a business opportunity. So when you send that money, you purchase the equipment, you buy the business, you do whatever that business opportunity happens to be. And if everything goes well, what does that business do? It's going to create cash flow. That cash flow, should those profits come back to you, what do you do with the profits? Once again, you're going to send them back in the form of a loan repayment. Now, these loan repayments are awesome because they're unstructured loans. All we know for sure is they're going to charge us some interest charge at the end of the policy year that's going to get tacked onto your loan if you don't pay it off. And as a good banker would always at least pay the interest. So you could make this an interest-only loan or pay principal, because when you pay principal, remember, this portion that was blocked off starts to less and less of it is blocked off with every repayment, so that money is accessible to you again. So now you're profiting here. You're paying some interest rate on that, but you're putting the money back in. Now, why are we okay with paying this interest rate? One of the common objections is, why would I want to pay interest to borrow my own money? Well, you're not borrowing your own money. You're borrowing the insurance company's money. And remember, this is a mutual company. So part of this interest rate is part of their overall profit. Who gets the profit? Some of this interest returns to you rather than what used to happen, just making the banks rich. So now, as this happens, this is growing. You decide to do it again. You've knocked this policy loan down. You're going to borrow more money. This time you want to buy some real estate. Once again, what does real estate do? Hopefully, if you bought well, it's going to cash flow. So that cash flow is going to come back to you. And again, you're just going to plug it back in here, repay the loan, rebuild your equity inside the policy, reuse that cash value, recapture some of that interest, recapture all of that. So over here, let's say you're doing real estate, you're getting all the benefits of real estate. You're getting cash flow, you're getting appreciation, hopefully. You're getting to depreciate the asset, so you get tax benefits. And there's a whole bunch of other things that can come along with owning real estate. Or maybe you're doing hard money loans. Once again, the same flow. That money is going to come down to the hard money loans. The hard money loans are going to pay you back. Well, all you did was borrow the insurance company's money. So you're just going to pay that back and complete the process. Now, why is this important? If I look at this on both sides, with anything except for an expense, except for something like a car, although it's still beneficial to do the purchases for this reason, but any of these things, what are they giving us? They're giving us a rate of return. And that's what we want to do with our money when it comes to investments. And at the same time, the whole entire time that this was happening, what's happening inside of our policy? All of this cash value, plus whatever premiums you continued to pay, continued to grow at interest and dividends. So it's also earning a rate of return. You're getting a guaranteed interest rate and you're getting the dividends from the company's profits. So this money grows for you the entire time, which means this pool of capital continues to get bigger and bigger. And what most of us need is access to capital. So we can have our money growing here and at the same time it's growing here. And even in the case of something like a vehicle, when it's not growing something here, it's still growing over here while it's being used for the things you had to do anyway. Instead of the money just going out the door, now you're recapturing some of that interest cost that's coming back to you while your money's growing. So, in a sense, this is the high level overview of why it's powerful, why the policy loan structure works. Now, once you understand that process, you can apply it to literally everything. You can apply it to car purchases where you're going to stop enriching, Ford Credit or Chase Bank or Bank of America. You can use it for real estate down payments, or even when you have enough cash flow, you can buy real estate out up front, but you can borrow against your own capital, pay it back into a system that benefits you. I mean, you can use it for business equipment. Your cash value then continues to grow while you have that loan out, while that business equipment is generating profits in your business. You can use it for hard money lending. You're going to use the insurance company's money at a small interest charge to loan to somebody else at a higher interest charge. Do your due diligence. You're going to make the spread and you're still going to make the money in your policy. I also use these policies as my emergency fund. I think it should be an emergency fund and then an opportunity fund. So why save it in the bank, making the bank rich at almost no interest rate when I can save it in this secure place that benefits me, benefits my family, provides a death benefit, and is still accessible. You can use it for everything. Every dollar that would have flowed to a bank before is now in your own ecosystem, flowing back to you, benefiting you over and over and over. I've been doing this since 2018. And I mean, I've funded cars this way. I've funded home projects. I've bought real estate. I've done hard money loans. Heck, I even use it to fund a brokerage where I trade options. I've used it for just about everything you can think of. And all the while, that money is still earning interest and dividends for me instead of just making the banks rich or instead of me losing the opportunity cost when used to spend cash. And the hardest part isn't the mechanics of it, it's the mental shift. You have to start thinking like a banker instead of thinking like a consumer. Now, I know some of you are thinking this sounds great, but is it really that simple? And the honest answer is the mechanics are pretty simple, but the implementation requires the right policy design and the right person to help you out. There's a lot of education that comes with this and a lot of shift in your thinking. And it's going to require a little bit of discipline on your side to learn the process and the discipline to pay yourself back. Not everybody should do this. But if you're the kind of person who's tired of enriching banks and wants to build real generational wealth, this might be exactly what you're looking for. And if you want to continue digging deeper into this, which each video is going to go deeper and deeper into it, subscribe to this channel. I'm releasing a new video every week breaking down how the infinite banking concept actually works in the real world. And if you want to book with us, the link will be below. We can get on a call, find out if this works for you. And heck, we can even go through policies that you have if you already have them in place, see if it's a good design, see if there's any changes you can make to your thinking, to what you're already doing. But we're happy to chat.